Hello, everybody. This is Andrew Hunziker with Dope CFO. Today, we are going to talk about 5 crucial tips for social equity cannabis license applicants. Really, a lot of this would apply to anyone who's opening a cannabis company. And so hopefully you can get a lot out of this. We will just jump in. We will try, I always say, we'll try to keep it under an hour because that's about the time people start getting tired. We'll look at licensing, capital raise, pitch deck, and financial model, and finally entity and funding structures. And we're just going to dive right into this. We always have a couple of slides on just the market opportunity. It's very, very, very big. We don't know what it's going to be. I've seen estimates of just the illegal California market over 100 billion. So what the size of these states will ultimately get to, it'll be very, very big. Usually these estimates just keep growing. We do have elections coming in November and some more states expanding as well. Now, on the flip side, the IRS is coming after these businesses. At our AICPA conference, I believe it was stated that the IRS gets $4 out of every cannabis audit versus $1 out of every non-cannabis audit. And so obviously if they're going to get a 4x return on coming after the cannabis industry, they're going to do that because, as we all know, our government needs money. So be prepared on day one. All the stuff we're talking about, you want to have a CFO on your team to help you on accounting, tax, CFO services, compliance, etc. So when this is yet another report from Treasury Inspector on the growth of the industry warrants increased tax compliance. Same thing, saying we need to ramp up compliance. And so we want to make sure, or you want to make sure on your end, the books and records and controls are all in place so that you don't get dinged when they show up. And we tell people, and again, at the AICPA conference, they're basically saying if you're a farm or dispensary of any size at all, over $1 million, which most are, just expect them to be showing up. And by the way, they show up way past when they're looking at. So they'll show up on your doorstep in 2024, but they'll be looking at 2022. So it's too late to fix things when they show up. So now I'm going to jump in, introduce our panel. I founded Dope CFO and teach around the US on everything accounting and tax for the cannabis and CBD industries. Hopefully you've seen us somewhere, and then I'm going to jump in and I'm going to let each person introduce themselves because they will do it better than I will. And all 3 of these people have been part of the Dope CFO program for some time and are experts in my opinion, and would be great to have on your team. So why don't I turn it over to you, Bruce, and jump in with your bio.
Hello, everyone. So my core business is under AndersonCPA.com, located in Woodland Hills, which is a suburb of Los Angeles. So we're in the great state of California, and we have, of course, been doing a lot of stuff with cannabis for a number of years. The areas I've been focusing on with small business have been business consulting, tax services, and accounting. And what I found in the cannabis business is the same drill: business consulting, tax services, and accounting. So it worked very nicely for us just to transition into the cannabis space. We actually have been watching the industry since 2007. That's when some laws passed, and it became interesting to take a look at, but it was not clear for CPAs about where they stood. So we waited until recreational was passed, and that was January 2018, and we've been going at it ever since. I make a note that I'm part of the Pro Advisor team for Intuit, because everybody, I would say 90% of people in the industry using QuickBooks. So it's nice to be able to say that you know something about the software that they're using as well. We branded under CannabisCPA.tax. We had another name that we started off with, and we found it didn't resonate well. And so we are now using CannabisCPA.tax, which hopefully tells people about what we're doing. Currently, we have clients across all spectrums of the industry: indoor, outdoor growers, manufacturers, distributors, and dispensaries. And we've also had the good opportunity through our association with Dope CFO to be more than just California dudes. So we're now in Texas, Colorado, Oregon, New York, and interestingly enough, I fielded a call this morning from Indiana, and I said, Indiana, what are you guys doing in Indiana? So there's some smart people with CBD as a background and thinking that cannabis is the next thing for Indiana. So we'll see how it turns out. But that's all I have, and I'll be speaking to you later. Thank you.
All right, that was a great intro, Bruce, and definitely a wealth of knowledge. And that's a great point. Some smart players in the industry are getting in on the CBD side because you never know. Some states are giving the first licenses to the hemp growers or whatever. And so that's an early play to get kind of, it's almost a call option on a license. So let me jump now to Toni and introduce yourself as well. She is, and Bruce, California, Toni is in Michigan.
Yes, hello everyone. My name is Toni Khan. I'm an enrolled agent. I've been in the accounting space for over 5 years now, started in manufacturing in the automotive space and then moved into construction after that. And it got boring. And I'm a science nerd as well. So cannabis fits the bill, it checks a lot of boxes for me. And Michigan is a great state to be in. I feel like I'm kind of late to the game, but with everyone on the East Coast, like all of us east of the Mississippi, they're starting to flip now. There's so much more opportunity and there's a lot of people that need help. So that's why I joined the space.
Well, that's awesome. And I like your last bullet because I think everyone on this panel, we're serving either all cannabis or 99% or whatever. And I think that's a good point. Most of the firms in the world are not, they're serving many, many niches. And this firm deserves a lot of attention. So that's great to see as well. Now I'll turn it over to Daryl and let you pronounce your last name so I don't mess that up.
Yeah. You're good. You're good. So I'm Daryl Gendris. I'm a CPA and I'm based in Illinois, actually a western suburb of Chicago. And the company I have is Green Rush Tax. And we handle the accounting and tax, throughout the US because we have clients, because of Dope CFO, we're nationwide. So we just handle all the accounting and taxes and all the verticals of that. So I've been doing state and local tax for 30 years. And then in the last couple of years, I saw the opportunity to get into the cannabis industry as Illinois started to get into recreational and that, and found this group. And that's where I just started to really, spread my wings and grow and learn from others within the group, along with Andrew. It's really helped me service my clients and, provide the best opportunity there is to, make sure that, we're minimizing their liability while maximizing their profits. So that's just me in a nutshell.
Yes, and and to highlight too, yeah, you have deep tax experience, which is super important in this space. Also, if anyone has questions, just type them in the chat because I can see the chat, but I have trouble when I'm sharing screen seeing Q&A. Also, if any of the panelists want to type in your email into chat, that will stay with that will live on to where how they can reach you afterwards if they want to as well. And then we're just going to jump right in, and I'm going to turn it over to Toni. He's going to do the first slides starting with tax codes.
Yes, we need to start with tax codes. It's the reason why cannabis is so complicated, and it's what makes cannabis not boring. So IRC 280E is the tax code that a lot of businesses don't know about, unfortunately, but we're changing that right now. The IRS federally states that if you're working with THC as a trade or business, you're not able to take normal and necessary deductions like ordinary normal businesses can. The only thing you're able to do is go through cost of goods sold. Some people try and get around it to beat 280E. We're going to go through why that's not a good idea and how we can work with that. A good tax court case to look at is the Harborside case. It goes into how they tried to beat 280E and it didn't work.
Yeah, and that's you can just Google it and read that on, it's quite multi years, and they lost $11 million at the end of the day, but it's a good read because there's definitely a lot of misinformation about things you can do or not do. So let's go now, overview of the licensing process. And Toni, I'll turn it back over to you.
Yep, overview of the licensing process. There's a few key pitfalls. You think these are obvious, but you'd be really surprised. You got to start with your application in the beginning. Is it complete, accurate? Has it been proofread for errors? Like, this is the first thing going in the door. It's like your resume. Like, you have to put your best foot forward. Do you have your location locked down? And then you're looking at your investors. First of all, do you have them? Are they funding the application? What's their cut? You need to figure all this out in the beginning. And then as far as approvals go, you will have multiple. So you'll have a city, a local version, and a state as well, depending on how that works. Because just because it's legal in the state doesn't mean it's legal where your location is. And that's something to pay attention to. And the final thing to look at is who's on your team, and do you have a qualified CFO helping you out?
And those are all great points. And even the last one, yes, many teams don't have a good CFO, and especially one like you all, dope CFO, specialized in the niche, because that's going to help give investors, you're out there pitching to investors, and you want to, like Toni said, put your best foot forward. And if you have a world-class CFO behind you, you're going to have a higher likelihood of closing that capital, because the investors are going to have more comfort that, oh, we've got things done right. A good dope CFO can even help you in those investor calls if needed as well. So that's super important. And same, like you said, in the location, and even like you said, the resume. I love that analogy, because yeah, I've seen a lot of pitch decks at applications, etc., with just typing errors or number errors. Make sure you don't do that, because that will put you at the bottom of the pack right off the bat.
Other challenges to look at in your plan, very important, are your inventory and your cash controls. Both of these, you have theft that's being involved. You also have, you want to prevent that. Then you have internal controls, particularly with inventory. That's a huge part of the accounting process, because your POS system, your state seed to sale system, and your accounting system, they're not going to talk to each other. There's a bunch of ERP systems that try and integrate. They're still not good yet. So you need to make sure that you're physically counting inventory every month, have internal controls, a process for that. Same thing with cash. Make sure nobody's stealing anything, no frauds going on. I mean, merchant services are also something you want to look at. Not all of them are cannabis friendly. Even for me, I had some trouble with Stripe, and I don't touch the plant. So you have to be really careful depending on who you're picking. And then as far as the reporting requirements, the state, the bank, your investors, they have different reports that they're going to want to see, that they're going to want either monthly, quarterly, or yearly. You need to pay attention to that. And finally, on this slide, looking at payroll and HR compliance. Payroll in particular, with me being on the tax side, if you miss those, if you're not on time with those penalties are 100%. So not only do you owe what you owe, but then you got to tack on another 100% on top of that. You do not want to mess around.
Yeah, that's a great point. And by the way, to highlight, Toni is an enrolled agent. And so that means you're actually certified kind of by the IRS, right, to do tax work. And so she knows what she's talking about on the tax side. These are all great points. What I like to look at this too is basically what you're saying is what, again, you would do for them as a client, is they're going to be audit ready all the time, because they need to be, when the IRS comes or another agency shows up, you want to make sure you kind of got your backside protected. And not like, even you mentioned theft. I think in our earlier group call today, someone mentioned that we pitched to a client, they decided to use somebody else, a full-time CFO, and they called back the dope CFO 6 months later and said, oh, we might want to look at you again. The person we hired stole $1 million from us. So be careful what you wish for, and make sure that you do have those controls in place. it's very, very easy for people to fool you and make sure you have that. And even those inventory counts, they don't just help you with your controls, they help you with the required cost accounting to do your 471 right. And then they also help with your tax return. You need that support. If they come in and say, what, you didn't even count inventory at year end, that's not going to look good on your tax return, and you're going to maybe get hit with other issues. Well, awesome, Toni. Make sure to put your info in here, and we'll and as well, if anyone asks questions, we'll toss back to that. Now we're going to turn over to keys to the great capital raise with kind of that great backdrop around controls and tax that Toni gave, and we'll hit it with Daryl. I'll let you jump right into the keys to a good capital raise.
This is, I think this is probably the essential part for a lot of companies right now, because as everyone's coming out, you're looking to build your build your business. So as you're going, you're gonna probably need investors on there. So, back in the early days, or the early investment side, those investors just wanted to get into the industry. So they weren't focused on the accounting side of things. And unfortunately, they learned the hard way that if, there aren't good policies and procedures in place on the accounting side, you're going to run into some issues. So, now what I've come across with a lot of cannabis investors is they've become much more demanding and focusing in on the financials and pro formas and everything else. So, when it comes to the cannabis side, or, the CBD and the hemp startups, those companies right off the start have to have good internal controls. And one of the main things that's needed is that perpetual data room, which basically then just stores all your information. So like when you do your month-end close, make sure, you upload all that stuff to the perpetual data room. Make sure you put it in like a good date. What I usually do is I go year then month. So when you close out the books, you can easily find it and just keep everything monthly. If need be, you can put it all in quarterly in those perpetual data rooms, just so it's easy to see, easy to access. So this helps show when someone comes into invest and they want to look, hey, you're very diligent in putting together everything, that you're putting your month-end close in a timely manner, your everything report-wise is, complete, accurate, reconciles. And, that the main thing too, like that third bullet point says, the investors are concerned about, taxes and accounting being properly done, because if not, going back to what Toni says, you can open yourself up to liability if you're trying to take any kind of shortcut on any type of cost accounting, and that, it could cost your company, big in the long run. And, investors and owners also too don't want to, deal with, tax assessments and penalties, potentially losing their license if, the accounting isn't, done correctly. And that, and then, there's certain ways of how companies are set up, whether it's the SCorp or any other entity structure, just as long as you're not trying to be 280E or, trying to put together two different types of companies into one, and we can talk about that, in further detail, Andrew, after we're done with this slide. Like where you're mixing together, like the common theme I'm seeing in some of these conferences are like the companies that have a farm and a consumption lounge, at the facility, and that. But sorry, I'm deep diving into issues like that. But the main thing is, it's just minimize, the audit issues, if there's ever going to be a potential IRS or state audit, or, any type of audit, whether it's internal too. And, and also too, you need to have sound compliance functions. So like if you're, lately now, like on the beverage side or the edible side, making sure you have the solid FDA stuff, or the USDA labeling on your package and that. So
I think
that's that.
I'll go to the next slide, and what I was thinking as you were talking through this, I was just thinking in the back of my head, usually when the social equity applicants out there pitching and their pitch deck and their model, the founders are all excited and growth and the sky's the limit, but you got to remember the investors are more thinking, what risk, where are we going to go wrong? Where are we going to lose our money? They're
Mhm.
worried on all the different places they can lose money: accounting, tax, license, compliance, etc. So you want to be able to give them all those comforts. And again, having a dope CFO on your side is going to be a big help on that.
Mhm. Mhm. So one of the things that does help that is having really good accounting procedures in place, strong cost accounting, where you can back everything up to that, just reconcile it, and it's just, the just the reconciling of bank statements to your cash on hand and just everything that just needs to be done. Just as long as you can put together a solid accounting department, it doesn't have to be a huge accounting department. Just make sure that they understand what it is. They can tie everything so that when you're rolling all this information into the pitch decks, most of these investors are also going to be rebuilding those pitch decks. So they're taking your information and they're trying to make sure is what you're saying really true. So then, like it goes back to is just everything's just solid on that part. So I mean, the way it looks like is, how much capital is needed. And that's always what I hear from a lot of investors, or when I'm looking at pitch decks, is what is your ask? What are you looking for? How much are you trying to invest? What are you trying to raise? Are you trying to raise debt? Are you trying to raise capital? Are you willing to give up some equity? But when you're going to be given that, what are you going to be using that for? So I think I'm sort of skipping around in the
No, I
slides, and
think
I'm sorry about
that's a
that.
great point, because that's one of the most key thoughts. More often than not, people underestimate the amount of money that they need, because they tend to overestimate how much they're going to produce and how much revenues they're going to make, and they underestimate expenses, and they also underestimate that things like the economy or whatever are going to bite them. So I like to see people have plenty of capital or a backup plan as well, because you want to make sure that you have enough capital plan, so if things go wrong, you can survive. And by the way, we now have a pretty good history that things do go wrong in states that have been around a while, like California, Oregon, Colorado. We see price collapse, or maybe production is less than you thought. So you got to plan for that. You're not always just going to produce the most you think and sell it at the highest price.
So on that next slide, where we go to the third one here. So it's just like, okay, so who are you looking to be your investor? Are you looking for, the true like angel network? Are you looking for family and friends? Or there are plenty of companies out there that want to get in the cannabis industry, or that are currently in there and they want to just expand their portfolio. And, a lot of those people, I guess you could say, and we could probably get into this when we get into the next section of pitch decks, is if you've ever watched the show Shark Tank, just picture yourself presenting to the group, and those are the investors, because it's so important that you need to have your information ready, but you also have to expect every question possible as they're going to go through and scrutinize everything that you have, when you're looking for investments from a group of individuals.
And by the way, Daryl, another great point. So if that's actually a great suggestion. Go watch Shark Tank, because first off, it's entirely entertaining to watch those people. But we were just at a pitch deck competition in Las Vegas, and those investors, they're pretty harsh. They will grill you, and you need to know and they'll start asking you what your EBITDA numbers are and whatnot. And it's actually really nice to have a CFO beside you to say, oh, Daryl will answer that question, or Toni, or Bruce.
Mhm.
And so to be able to know, okay, you've got that support. And then if you're a social equity applicant, you've got to be careful too. It's a little bit of a different situation. You might have a little easier time finding investors actually, but you have a different kind of problem sometimes. And we actually talked to someone in New Jersey about this problem today. There are people, I call them sharks, a good word, coming back. They're trying to get in and entice you with, hey, we'll give you a lot of money to help you get your license, and we just want 20% of the company or whatever. But you got to be super careful. We've seen investors do very shady things to try to get more and more of the equity than they should get from some of these companies. They're like, hey, we'll give you 100,000 to help you build the license, but we want 40% of the company. That's too much. So you need, again, a dope CFO behind you can help you look at that and negotiate with those investors and make sure you are not getting a bad deal, and knowing what comparables, kind of like you use a realtor when you go negotiate to sell a house. You want to know comparables. You want to know what the market says. You don't want, if your next door neighbor sells their house for $1 million, you don't want to sell yours for $500,000 because you're just not knowledgeable. So be super careful on that as well when you're out there doing your kind of pitch.
So this next part is the essentials of the pitch deck. And in all honesty, today I already reviewed 2 different pitch decks from 2 different types of companies. And it's really important to have everything together. So even if everyone puts together their own pitch deck, it's very important to have one of us or anyone from the Dope CFO group review it, because we've been through this before. We know what the investors are looking for. We know what the questions the investors are going to ask, because it's like, if you have straight line revenue growth, or if you see this, huge spike, of revenue, where do you think this is coming from? Disclosure competitors, you really have to be knowledgeable. And then, you just can't say, well, my company is similar to those MSOs, so I'm going to sort of use like their revenue stream. No, your company is either a single, dispensary or a single grow. You're not, a large company. So you have to be realistic when you're putting in together your revenue growth, and that, because you're truly, mostly at the startup stage or year 1, year 2 of that. So be realistic. This is where, we give our insight to help you put together your pitch deck.
Yeah, and so that's a good example. We do have a checklist to make sure everything, so we'll find missing things all the time, including even the offer of what are you selling. But also just make sure that you're when someone looks at your deck, you have to be able to differentiate, why is your company better? So if you say, well, I got a farming license and we can grow 10,000 feet and we're going to grow pot and sell it, that's not really a great pitch. You got to have some kind of value proposition of what you're doing better, and don't just talk about, oh, I've got a license and I can sell a lot of pot or whatever. And oh, by the way, my pot's the best. Remember, every last deck that ever talks about growing weed or making a gummy bear or whatever is going to say ours is the best. It's better. And so investors they're like, oh yeah, everyone says that. We need something better than that. So let's go to the next one.
Right. So it's, and like Andrew was saying too, it's the competitive, why are you better? Just, you have to say, okay, maybe we're having this unique product, or, maybe we have something that no one in this region, is offering. Then yeah, there's your competitive, advantage. Or, is it maybe where you got your license and you're going to put your dispensary, could it be in a saturated market, or are you going into a community where you're on a border state that has no recreational or even no medicinal, type of cannabis, to where you might be the only, company in town. So there's a lot of things too. And then just, be smart and realistic on your pricing and your margins and in your business model. And it's just, the main thing that these investors are looking for is, what is the ask? How are you going to use that money? Because picture it as if, flip it the other way, a child or relative, a child or a niece, nephew is asking you for money. You're just not going to hand them over money. What are you going to do with it? It's the same thing these investors are doing. You sort of have to look at it like that, of like, okay, if I give you, $5 million, what's the first thing you're going to do? And you better not just say, oh, I'm going to get a marketing person and hire someone to help do social media for me and become a social influencer. That's not what these investors want to see. They want to see you constantly investing in the company.
And that's a great, I
So-
love that metaphor of the parent asking child. Yeah, like you would be like, oh, wait a minute. It'd be like your kid saying, I want $1,000. And you'd be like, what? What are you going to do with that exactly? And even these investor economics down here, if you can impress the investor that a little bit, what ROI is, what time to pay back, or what's your company valuation? Is it reasonable? These are things investors that can impress them right off the bat instead of just handing them a P&L. So great points. Sorry, here is the last slide on kind of pitch decks, and I'll let Daryl hit this one as well.
Yep. So like the last one is the offer, and the offer is key. You're not going to ask, and you'll see that on Shark Tank when you watch. It's just like, you're not going to come in and say, well, I want 5 million, but I'm going to give you, 1%, or,
That'd be really good.
Good for you, but not good for the investors. So you have to, before you approach, you have to be fair to both sides, and like I had said earlier, these investors are going to rebuild your pitch deck. So they'll know if you're full of baloney if you don't give them, if they come back and say this, as they start building it, they start seeing a gap. So just be realistic, and then be realistic in your traction of, how long have you been in business? How much has your revenue been? How are your sales? Do you have something tangible? Are you actually growing, or is your business struggling? Because this covers all verticals. It's just not the dispensaries and that. And then the last part is just, as you get further along, you need to get attorneys involved in this, with the capital raise too, just so you don't sign up for one-sided deal.
Yeah, and that's a great point to end with on. Make sure you've got a quality CFO and then a good corporate attorney, because I've seen more than one deal where someone's like, oh yeah, I sold, Sally, my neighbor, 200,000. That is illegal. There are lots of laws protecting you from doing that. So you got to be careful you don't get your own self in trouble trying to sell somebody part of your company without doing things correctly. And so make sure you've got that good attorney and a good CFO, like anyone on our panel can recommend one if you don't have one as well. So that's huge key. Thank you, Daryl, for that. And now we're going to jump in to Bruce, and he will take us through the last. And I love to look at financial models. You darn better have a good accountant involved in this side of the things. Wait, Bruce, I got you on mute. You're on mute.
So I think this is still you. I pick up at common entities.
Okay, this is still me. Okay, so
Yes, please.
I know we split our slides up. So basically what I'll say on a model is going to be pretty quick. I have seen probably 1,000 of these the last 20 years. And I come at it from every angle. I have been an investor of tens of thousands of dollars and even six figures in more than 5 startups in the last 20 years. I have co-founded at least 5 startups. I've been a CFO of startups. So I've worn every hat, and most of the models I see is usually just a whole Excel file with a bunch of tabs and a P&L. Make sure you have a complete model that includes a P&L, but you don't only spend money on revenues and expenses, you also spend money on capital items like buying inventory or real estate or et cetera. So you need a balance sheet, a statement of cash flows. We want to see key assumptions, and we want to know, we really want to look at what if scenarios. So if I'm investing in your farm and you tell me you're gonna sell your pot at 2,000 a pound for the next 6 years straight, I'm going to say, well, first off, does that model can I play around with the price of it? Maybe I want to punch in 1,000 a pound and see what happens to your whole model. So I call those switches and inputs where the investor can play around with how much production you're going to do, what price will you get per pound, and be aware that prices can collapse. We saw Oregon's been between $2,000 and $300 a pound, or 200. And the scary thing is, when prices tank, it doesn't even mean you're going to sell your pot at 200 pounds. You might not be able to sell it at all because the market's flooded. So you got to be able to think of those assumptions, including payroll, and then having some kind of summary tab that shows all those metrics to the investors. But you really want someone who knows what they're doing with this model. I actually like to build the model first, because if the numbers don't look good, and your deck's not going to look good. So you could kind of do them like the deck, maybe start with, oh, we're going to have a farm and we're going to specialize in this and this, but then let's go look at the numbers, get that model good, and then let's finish the deck, so that you don't do it the other way around. Let's build a deck and just say, oh, we're going to do 3 million in sales in year 2, and then we'll back into that, start the other way around. So be careful. That piece is very, very important, and you really need qualified help in that. I've seen many founders make their own models, and I'm just like, please don't do that. And the last deck I saw, actually at a social equity applicant at the pitch in Vegas, they had one slide that said they were raising 400,000, and the very next slide said what they were going to use the money for, and they said they were only going to use 200,000. And like, that was just basic. That's like 5th grade math. Yeah, make sure that stuff adds up. So Bruce, I'm now turning it over to you, and we're going to look at entity issues, because again, this is a very important piece of the puzzle.
So I wanted to not come across as a social media influencer, but I did want to make a comment that sometimes in this industry you get some really cool tchotchkes. And so I wanted to mention that these gold sunglasses now have persevered 3 years of trudging around through conferences, this, that, and the other. So I just tell you that occasionally you get some good stuff and you just got to hang on to it. Unfortunately, I asked them for prescription and they said, no, we can't do that. So,
and by the way, but before you start on that note, Bruce, I will say this is another key of Dope CFOs. We're actually a lot of fun. Like we may look like a bunch of old fuddy-duddy nerdy accountants, but we actually do have fun. We go to events and we help out. And yeah, I will say, I remember last time I saw Bruce was, I think, in Las Vegas, and I had to go to bed about 11 o'clock and he was still going strong. So
yeah, we get some good hats too. So
I love that.
You know, if you want to just be kind of incognito and so forth, just get your hat out, get your sunglasses out, and you're equipped to go. Anyway, back on the serious stuff. So I'm going to cover about 4 areas. One is going to be the SCorp. Secondly, then I'm going to take a look at LLCs and SCorps, which are flow-through entities. Then we're going to take a look at multi-entity structures, because we can do some slice and dice kind of combining of these things to have the best benefit. The last thing we're going to touch on is the funding structures. So SCorps. So it's an interesting concept, because if you take a look at the public companies, you're going to find that most of them are SCorps, and it's kind of an understanding that they're easier to raise capital with. Corporations have a flat tax. They are going to pay their own taxes, so therefore this is an entity that is set up so that it is isolated a bit from the shareholders and investors and so forth. So therefore, from that, they derive some asset protection. When we do audits, God forbid there's any kind of IRS auditing or anything at any other level, then these corporate entities are going to be standalone. They're going to be audited as they stand, but they're not going to draw in additional personnel or investors and so forth. It's interesting, I picked up a case recently where the engagement has been, the IRS engagement has been completed. It's ready for review with management. They called me in to take a look because they didn't feel that maybe they got what they needed to out of the original CPA firm. So I go through this thing, and all of a sudden I find out that there's like a couple of pages in a couple of different appendices that list out all the investors. So here these poor guys, and this is a fairly, this is not a big case, but there's some dollars on the line, and yet it's going to potentially impact all these hangers-on who thought they're going to just be nice to invest money for their grandkids and for their, for their siblings and whatever else. So this is kind of turned upside down for them. So that's been kind of a difficult thing. There's also a code section 1202, which is a small business code section within the Internal Revenue Service. And what it describes is that if you were to start as a C Corp, then if you held for a minimum of 5 years, then you could shelter 100% of the long-term capital gains associated with that asset, that company, if you choose to sell. So that's a pretty interesting concept. I'll make a comment that a lot of times we get involved with picking up entities and they've already been formed. They're already functioning, so on and so forth. And so one of the comments is, well, I'm an LLC. Okay, tax is what? A partnership. Okay, well, so their friends have all told them, it's like we used to talk about years ago. Everybody has a brother-in-law that sells insurance. I think everybody in the cannabis space has a relative that also does some side work for H&R Block or somebody. So therefore they get this tax advice that sometimes is suspect. And so what happens is that they are told, well, we should maybe elect to be taxed as a C Corp. Well, so if they do that, that's fine for the duration of the time that that entity is in existence as a C Corp. Has to be a minimum of 5 years that they retain that entity type for tax purposes. But if you're not originally being formed as a C Corp, this 1202 doesn't apply. So that's something in the tax planning mode that you just need to be aware of. Now the cons, double taxation. Well, so I can say that that's factually correct, but I can also say that, you know what, it has some benefits to being in this kind of configuration, because what can happen is that if you are a C Corp and you have a need for continuing investment, then what happens is as a C Corp, you basically pay tax on that money, but it's retained within that business entity. We're going to talk about LLCs a little bit later, and I'll be able to do a compare contrast. But sometimes this C Corp actually is more efficient tax-wise if you're going to be reinvesting money. Okay.
Well, that's a huge point. I just want to reiterate too, because that's the general, there's not generally going to be money for dividends at your dispensary or farm, because you are going to be investing in the company. So that's a really big point.
So then with regards to setup and maintenance, I have to tell you that for 10 years plus in my little CPA accounting practice in California, if somebody said, oh, I want to form a business entity, I'll say, well, that's a paralegal function. So I'll go ahead and help you set up a this, that, or the other. And what I have to tell you is that with the cannabis business, it's like, I don't even touch it. I don't even want to have any discussion about it, because there's so many nuances about what it takes to set up a C Corp or an LLC or a partnership or whatever else, that as a non-practicing attorney, you're doing, and I'm not an attorney, but if you're anything other than a practicing attorney, you're doing a terrible disservice to your clients to try to dream up some way that they should be setting up their entities. It just does not fit in the cannabis space.
Great
With
point.
regards to, go ahead, I'm sorry.
No, great point.
Yeah. So anyway, that's the comments on the SCorp. I'm going to come back to it for some follow-up items. Thank you very much for advancing.
Good.
So now LLCs. An LLC is an entity which is a figment of the imagination of any states, but it does not even exist anywhere in the Internal Revenue Code. So therefore, if somebody says, and I mentioned this morning, I was on with a gentleman from Indiana, and he says, I'm an LLC. And it's like, okay, well, that's great. I had a conversation last week with another individual who said, oh, I'm an LLC. And I said, well, that doesn't help me. I can't start doing any tax planning or understanding what you have until you tell me what the form is. So pull out the form. So we pull out the form and we find out that it's a 1065 and we go, oh, it's a partnership. Okay, well, that makes sense. But you have to get down to the nitty gritty with regards to any of the LLCs or SCorps. The huge biggest difference is that these are flow through entities. So therefore, when you complete the business tax return, what happens is that at the bottom of the form itself, it says net income or loss. And then that translates over to a K1. And that K1 then goes to whoever the owner is. Now, generally, that's going to be an individual because a lot of times individuals are going to be the investors. But it may be that it's going to a C corporation. So now, here's an interesting example for you. So some people like certain parts of the industry. So I have some people love this, they love the dispensaries, they love the retail stuff. So they get a store and then they think they're going to get another store and then they get another store. And then I take a look to see what the ownership is or what it should be. And so if there's a C Corp on top and there's every one of these little guys these individual stores are set up as single member LLCs, it's a beautiful arrangement because all those K1s conduit up to the C Corp, and there's a one tax bill that's being paid at that level. But you have some very nice synergy among those different entities that are set up as these single member LLCs. If at any point you want to sell one, you just pop that guy out of that system and you go ahead and sell off, and it seems to work okay. A lot of times what happens when you have that kind of a structure, even though they're LLCs, they seem to be very closely akin to a C Corp arrangement from a lot of attributes about they're not too fancy, so on and so forth. So therefore, that kind of passed the mustard test about LLCs being not too difficult to work with. With regards to the pros that are on this list, easy to maintain, low cost of setup, the reason why that comes about is because corporations are mandated to have a corporate set of books. But with regards to LLCs, it's like they don't need that. It's nice to have it. It's really a tremendous protection tool when you're in the cannabis space, particularly to be able to document you made an investment in this property, this equipment, you had salary ranges being such and such for people, so on and so forth. But those are auxiliary things that aren't really mandated to be part of the core set of books. But yet in the cannabis space, a lot of times your maintenance of your organizational records should really look very much like a C Corp. Okay, one single tax. Okay, so here's really one of the big difficulties with the way in which reinvestment may work within an LLC arrangement. So I just mentioned before on the C Corp slide that if for every dollar that somebody wants to invest in a cannabis shop, there's really $2 they wish they had. So therefore, they're always looking for more money, more money, more money. And so therefore, under a C corporation, what we talked about is pay the tax and then reinvest the money. You could also throttle that because if there's also going to be this piece of information that says, I need to have some distributions coming out to the shareholders under a C corporation, you can throttle when that happens, okay? With an LLC, what happens is the business entity files its taxes, it has a K1, income or loss goes straight to the individual if they're individual ownership, which a lot of the investors are, and then they pay taxes currently every year, year by year by year. There's no adjustment, deferral, arrangement, and so forth. So therefore, if in turn, these owners that are single, that are the investor group, if they're asked to pony up more money, they're going to be reinvesting money into this business, they have to do with after-tax dollars. So it's even harder for them. So sometimes what I see is that there's a dilution in the equity of these original founders and partners in these businesses. So that's really a tough thing to swallow for them. Let's take a look at some of the cons. What happens if you're a member of an LLC and you're an active member, not a limited partner, then you're going to have self-employment tax that you're going to be faced with to deal with. With regards to auditing, what's going to happen is that those audits are going to also be touching any of the owners involved also, because the audit is not contained just within the business entity, because the owners are pass-through investors. They're going to be potentially involved as well, not during the course of the audit a lot of times, but when the final bill is rendered saying, oh gosh, you owe some taxes, then that's where the investors are going to be involved, which is really a difficult thing as well. Potential for tax payments without cash. So that's something that I've dealt with for years and years with non-cannabis, but it's even more dramatic with cannabis. And what happens is they, again, at the end of the year, and again, I'm going to go back to all the investors or individuals. So they get their K1s and they get them sometime after the end of the year, and they look at them and it's the good news, bad news. Oh, wow, look at all the money that we made. And then the bad news is, oh, there's tax I have to pay on that. So at that stage, what's going to happen is they're going to go back to whoever runs that business, whoever has the LLC, and say, look, dude, I don't have money. So therefore, what happens a lot of times is either it's like, sorry about that, you're on your own, or if you have a better arrangement, then what may happen is a year following, and this is every year following the year that just closed, then that LLC is going to have to be making some kind of distribution to some level to each one of the owners. So that's a real difficult thing to manage cash flow wise. And that's where a lot of times when you get involved in the ownership of the founding members, that sometimes you have to really make sure you're tight on the understanding about what that all means. So and then SCorp. So we've had situations where through court cases, we found that sometimes owners' wages, if they're not being able to get pushed up into cost of goods sold, then they end up being double taxed. Because on one hand, they are subject to 280E, so therefore there's non-deductible expenses. So therefore that resulting K1 is going to be increased by the amount of wages of the owner. On the individual's tax return, they're paying the full pop for the W-2 wages, and they're paying that inflated K1 net income. So therefore that's a double taxation thing, which we don't see other than in a business like a cannabis space, where we've got a 280E provision that's laying over the top of our head. So that's a tough one to deal with. So if somebody is an SCorp, what's the resolution of that? They can always make elections to be taxed as a C. When you start off as an SCorp, you can't say, oh, no, that was a mistake, I want to be just a partnership. That doesn't fly very well, but you do have an opportunity to potentially request that you become taxed as a C Corp. So that is available. Okay, next slide, please.
So
Go ahead, I'm
those
sorry.
are all great points, and I just want to reiterate, and this will be our last slide on structures on multi-entity, is just being able to look at these pros and cons, and Bruce is doing an amazing job of explaining this, because a lot of times your attorney may be very smart, but they might not highlight all these pros and cons and just be like, oh, you just need to do this or this, and we'll beat 280 or whatever. But this is really good to think through what Bruce is going through here now.
So now multi-entity. So, you know, the thing that from the dark past was that there were these clever arrangements where you basically set up a management company because now that management company is not subject to 280E, all those kinds of things. The first thing that all of us need to remember is that if under the one entity concept, that business line item was subject to 280E, if it gets moved to another entity, it's still a subject to 280E. So the simple one to take a look at is payroll. And so under certain circumstances, then payroll works fine for cultivation, manufacturing, doesn't work fine for if you're selling stuff like distro or retail. So therefore, if in fact that payroll gets pushed off to another PEO type model, you could still own it, but it's separately assigned with a separate EIN. What can happen is that you may have some advantage to that, just and not for 280E consideration, but just for legal protection. Because what can happen, and this has been recently, had some discussion with some attorneys that do some labor stuff in California, and they said, look, if you at least, you know, take those employee claims and put them off in a separate business entity, it is not going to penetrate back through to the license holder. So that I thought was an interesting concept. You have some other issues that are listed here proposed, which is easier to get banking and so forth. Banking, there's about 300 banks nationally that will bank cannabis, and there's about a third of all of the credit unions nationally will bank cannabis. You just have to work hard to find where those guys are at. But other than that, the multi-entity structure, in some cases, I've had attorneys kind of just whip through things, and they don't have the depth of knowledge that will do all the protection needed. So, and yet we're just, you know, we're just bean counters here, you know, and so therefore we just have to say things like, have you thought about, or what would happen if this were to be occurring? But other than that, you just have to say, look, make a note in the file. I talked to the attorney because I thought about this situation and I was wondering if this could apply, blah, blah, blah. And the attorney said, don't worry about it. That's legal stuff. You go count your beans. And if that's the case and you put it in your file, you're good. I mean, you still may wrestle with it, but still it's not so bad. So with that, I think there's a funding structures, but I don't know if we have time to do much with that. I think we're coming right up on the top of the hour.
Yeah, and I think Bruce, this has been a great talk. You've hit the main points on funding structures. That's just at the end of the day, when you're raising capital, you're going to have to decide, you know, are you going to issue a convertible note? Are you going to sell direct equity? Are you going to sell a safe agreement? That's kind of more into the weeds than you probably need to get, but let's look at the bold on bottom, make sure you've got a good corporate attorney. And like Bruce said, you can say, have you thought about this? And sometimes I'll say that exact thing. Have you thought about if that strategy that attorney told you to beat 280E falls apart, like Harborside, are they going to help you defend you for free? And are they going to help pay the tax bill? And that's a good question to ask your attorney. They're like, no, we're going to charge you on that side too. So just be careful on that side. And we're a great team. This is our first presentation we've all done together, and we hit it in just under an hour. I think one thing too is that I like to say, I think the beat 280E message came, and like Bruce said, the old adage, we'd be at conferences and just every person that walked up to me, how do I beat 280E? Or they said I could do this to beat 280E. And we say, a better way is just to do 280E correctly and correctly minimize your tax. We can do that the correct way. With the qualified dope CFO that can do the cost accounting. This has been, let me see, I'm going to stop the share. So can everyone see the chat? This is how to get, and even Tyson posted again, all the contact info. So that's great as well. And thank you everyone. I want to thank my panelists for presenting and the attendees for coming. Daryl's got his hand up, or you're just waving? He's waving. Okay. I was like, he has a question, but yeah, and feel free to reach out to them. They will help you. This is the industry we've all focused on. So we're here to help. Well, thank you everybody. And Tyson, you can quit recording and we will, we'll send this one around and I'll see all my panelists back in the group, and thank you all for joining us.